Hopefully everyone can hear me. Anyways, welcome to 5 Secrets, Trading Options Like a Professional Trader. I'm Jay Soloff from Investors Alley, and Options Profit Engine is my trading service. So we got a lot to cover, so I'll just briefly touch on me. I was a floor trader on the CBOE. I've been doing this for about 20 years, and about the last 8 years have been in this industry, the investment newsletter industry. So the important thing to know is that most people think the reason I look like this now instead of that is because of being a trader. That's not true. It's actually because I had kids. So that's, I was perfect until I had kids, and then I gained a bunch of weight and got gray hair and stuff. So, I mean, trading really had nothing to do with it. All right. February 5th was obviously a very meaningful day. Now, if you were just a stock trader, it was, whatever, 4%, 1,000 points in the Dow. It was meaningful, right, but not necessarily black swan type event. Now, if you look at what happened in volatility, so this is the SPX, the S&P 500. We had obviously a very big down day after a couple big down days and then a really big down day. But what happened with volatility at that same time was enormous. This is SVXY. It's a reverse, it's short volatility. All right, so question first, how many people here have traded a volatility product like VXX or XIV? Right, so maybe a quarter. Right, it's a pretty popular thing, or it was, because the short volatility trade was enormous. It was probably the best, most reliable way to earn yield for about 2 to 3 years. So a whole lot of people were short volatility, meaning short the VIX, either short selling VXX or going long SVXY, which is the inverse. There are a few different ways of doing it. XIV was a very popular one. That's the exact reverse of VXX. So what we had here, though, was a pretty big down day, but it triggered a massive event in the volatility ETPs, exchange traded products. And the reason is because we hadn't had anything like that happen since the ETPs really came about after the financial crisis, 2009. So they hadn't really, by contract, they have some kind of obligation to buy or sell VIX futures at the end of the day in order to keep their product balanced. But we hadn't had a really huge day to really test it out. So what happened is that it wasn't really expected. When we had this massive sell-off and this huge ramp up in volatility, it basically destroyed these volatility-related products. XIV went away. Right? If you were long XIV, you lost 100% of your money. SVXY went from, something around 100 or 90 to 10, right? It opened the next day. It was completely unheard of. So afterwards, I went to a conference. It was for institutional. It was a CBOE conference on options. And that's what everyone was talking about. All these institutions and pension funds, they were talking about this volatility event because they trade a lot more volatility. And I asked around. I'm like, all right, so you guys lose a bunch of money? I mean, who lost? Nobody lost money. None of the institutions lost money. Everyone maybe mentioned there was one fund, short volatility fund, that blew up, right? I'm like, well, I kept reading that people got killed and lost money and lost their livelihoods. No, it was all individual traders. Institutions didn't get touched by this major event. The question is why? Well, first of all, let's say you have Bob, who's an institutional trader sitting at his desk. He gets a call that day in the afternoon from, Fred, his buddy, and he says, hey, I heard that, Credit Suisse is going to have to buy, 100,000 VIX futures at the end of the day to make XIV work. So he's like, oh, okay. So he calls up, Ralph and says, Ralph, buy me, this is after the market, maybe at 3:05, where most of us are already done. He calls up and to his buddy and says, hey, buy me 1,000 VIX futures. And, if they lose money on it, big deal. They write it off as a hedge. And if they, and if it goes up, they make money. And he calls Fred, says, hey, thanks, I'll buy you a steak and a scotch later on, right? So what I'm saying here is that they have access, right? Institutions have access to things that we don't have access to. That's one. And I'm sure that happened to some extent where they just have, pardon me, after hours trades, they have unlimited resources, they can get in and out of stuff, all right? That's part of it. Certainly there's that advantage that you have by being an institution. But the other part is that most of the guys never had the kind of worry that they were, long XIV and it goes to zero. That was not something they were worried about because everything they did was probably with options and it was probably hedged. So they knew exactly what their risk limitations were. And that's really, I think, the point of what I'm going to show you is that you can make money. There are a lot of ways to make money trading options. You can do it for short to medium periods of time. And I think anybody can do it, right? But it's when you have one of these events that wipes you out, that's where people run into trouble with options, is that it only takes one event to wipe you out, and you got to be ready for that because it's easy to make money. It's very hard to not eventually lose it all. And so what I want to focus on is just tips and tricks and strategies to really give you peace of mind more than anything else. So this doesn't happen because I know people who wrote into fund managers and said, like, I lost everything. I lost my retirement. That should never happen, right? I mean, obviously, unfortunately, it does, but it should never happen, particularly with options, because options are the easiest instrument to hedge and to define your risk. All right, so number one, and I'm mostly going to talk about strategies. This is the one, though, is the most important thing out there that I've learned, usually the hard way, which is trade your edge. And what that means is options have a million ways to make money, right? But not everything is right for every person. So you can make, the good thing about options is that you can make money doing almost, I mean, you can make money on the long side, you can make money on the short side. There's a whole lot of ways to make money. And there's not really a right way. I mean, you hear a lot of people say, well, sell options at higher probability. And generally, I'm a short volatility trader, and that's how I make money. I know a guy who was in the pit with me. He's traded options for 20 years, who's almost never short. He makes money on the long side and has for 20 years, and he's a professional. So it doesn't matter. You pick what works for you because you have a certain personality. Some people just don't want to make $100 and risk $1,500 a month, on a single trade. So, they don't, even though it's high probability, the downside looks really bad. They're not comfortable with it. Some people would rather, all right, hey, I'm going to only win 20% of the time, but when I win, I'm going to make 400%. I mean, you got to do there's a certain DNA in options trading. You got to do what's right for you. So, for instance, I'm a short volatility trader, and after February 5th, the first thing I did was sold a bunch of put spreads, sort of across the board. I like tech stocks, so a bunch of tech stocks got hammered. I sold a bunch of put spreads in tech stocks, and it immediately went, and within a week, they were all winners, right? That was what I'm comfortable doing. But then the market stayed volatile, and it was really choppy, up and down for, actually for a couple months. And I started thinking, well, man, I'm missing out on these big moves. I need to be long. I need to make money on the long side, on directional trades. And realizing, but not really thinking that is just not my, after 20 years, I should know, that's not my game, right? And so while I had some of these things work, it wasn't nearly as successful. And the key is that it's not my DNA. My DNA is to find things that are overvalued and to short them. That is what I'm comfortable doing. I mostly do that in Options Profit Engine, and generally very successful with that. So you got to stick with, not all, obviously there are times for everything. There are rare circumstances. You got to be nimble, but your core strategy should be something that you're very comfortable doing. It's hard to quantify that, but it's one of the most important things I can tell you. All right, number two, I'm not going to spend too long on covered calls. We have Alan Ellman coming up next, and his presentation is going to be on covered calls, and I don't want to, steal his thunder. So the main point is, and I'm sure I agree with everything that Dr. Ellman's going to say, that covered calls are amazing. Use them as often as possible, right? It's when you look at, if you were to go and look at all the block trades, and there are several websites and things out there where you can look at block option trades that have occurred during the trading day, and you'll see that 10,000, 20,000 option block, almost probably at least half of them are going to be covered call trades. Huge trades done by institutions and funds. They're buy rights, they're covered calls. They're done constantly every day. It's a huge business, and there's a reason for that. It's because it's ultimately one of the best ways you can earn yield, right? I mean, buy dividend stocks is one, sell covered calls is the other one, right? Particularly when dividend yields are low, covered calls are even better. So just, most of you are probably familiar, but covered calls, obviously, when you're long the stock, you sell a call against it, and the idea is you're just earning the money on that call. So what happens is that if the stock goes up, then your covered call takes out those shares, and you've made money on the stock going up, you've made money on your call, right? It just limits your upside a little bit. If it goes down, you have a little extra protection from your covered call. And then if it stays the same, you don't make any money on your stock, but you still make the money on your call. I'll show you, but I'll show you just some scenarios real quick. But I wanted to show this, when I did this, I pulled this example literally last week because I wanted to have real examples. I wanted to pull something off the actual trading wire to show you. This was an actual trade last week on May 7th. Someone purchased 100,000 shares of Apple at 186, and they sold 1,000 of the May 18th calls, not 192.50 for 84. So this was a 10-day trade. They're collecting 84 cents, so $84,000, which is, it's about a 0.5% yield, but it's 10 days. So think about that. If you do that every 10 days, you're making 1.5% a month, which is, what's it, like 18% or something annualized. Not to mention they have $6.50 of upside every 10 days that they can make in the stock. So this is real stuff that goes on. It doesn't necessarily have to be a huge credit because you're doing it regularly. And what happens if the stock goes up? Yeah, you can limit your upside, but generally speaking, your calls are going to expire before your stock breaches that. I mean, you have to, there's, Alan will talk about this. You have to do a little more research. It's not just picking stuff willy-nilly, but yeah, go ahead. Yeah, so it can be, so if anybody exercises it early, the only time that should ever happen is right before an ex-dividend date. That is not something, the question is, someone could take you out of the stock, and someone could technically take you out of the stock early, because American options you can exercise at any point. And the thing is that there's really almost no reason to exercise early. It's usually related to a dividend event, and that only happens 4 times a year. Exercising early is generally a bad strategy. So if people do it, then they don't generally know what they're talking about. So hopefully you won't get exercised early. But the other thing is that if your stock shoots up and you get, your shares get called away, you could just buy them again, right? I mean, it's not like, and you still made money on the way up. So it's not a situation where you're losing money. It's just maybe you're not making as much as you want. And so just, looking at, just so you can see these scenarios here. If the stock does nothing, this is what I was talking about. You make 18, so on that particular trade, if the stock just sat there for a year and they did that trade over and over again, they make 18%. Obviously, this is theoretical. If the stock goes up to 192, they make 650,000 on the shares plus the 84,000. So now again, obviously, you're not going to have $6.50 every 10 days, but if you did, that would be 144% gain. So, but that's still that in that 10 days, that would be a 4% gain, which is obviously great for 10 days. And then on the other side, you're protected 86 cents down. So it was a 186. So you have 86 cents on the downside before you start losing money. Now, this brings up the pros and cons of covered calls, which again we've talked about. So the pros are in almost any environment they work, right? The environments that they don't work is if we had a year where stocks are down, let's say after 2009, stocks are down, 30%. If you expect them to go up 30% the next year, Generally, not the best time to do covered calls because you're going to blow through your strikes, and you're going to, if it's a situation where stocks are flying, then you wait on your covered calls generally. The other thing is obviously if you're really worried about a crash, right? If things are going crazy, war breaks out, inflation's crazy. Again, if stocks are dropping, covered calls are only going to protect you to some amount. Instead, you're going to buy puts or some kind of hedge, right? So really in a crazy up or crazy down environment is the only time you're really not going to want to do this. They're very easy to do. You can usually do them, with one click on your broker, buy 100 shares, sell a call against. It's usually one transaction, and it's consistent income. You can do it weekly, you can do it monthly. Monthly is probably the sweet spot. Quarterly is another one that people like to do. As I said, you can, the con side, you can cap earnings in a high growth environment. The other thing is that you have to buy the shares. So it does take a fair amount of capital, right? Every call that you're selling is the equivalent of 100 shares. So you have to have at least 100 shares. So if you're trading Amazon, obviously you're talking about a massive amount of capital. Now, if you already own shares in your account, there's really no reason. There's no reason, pretty much, no obvious reason to not sell covered calls against your existing shares. You've already spent the capital. You might as well earn some yield, right? And even if you get called away on your shares, you just buy them again. You haven't lost any money. So, all right. So I'm going to move on, and Alan will talk about this more later. All right. This is one of my favorite software programs. It's called cmlviz.com. I don't have any affiliation with these guys. I just love their product. They are the only company out there that I've found that actually lets you backtest option strategies for most any strategy, and it's something like, it varies, it's either $50 or $100 a month, but even if you're to sign up for a month and test a bunch of your strategies, it's cost you like $100. You can put in most strategies and backtest them. It's really the only retail product out there. I mean, normally you need something like a Bloomberg terminal, which costs $2,000 a month. So this is a great product if you ever want to backtest strategies. So I just wanted to do some theoretical situations where you're buying covered calls. This, I believe, is over a 2-year period, every 30 days. And I use 5% out of the money. So that just means that I'm picking options that are roughly have a 45% probability of success. Just your basic kind of out of the money option. 5% is probably a little much. You're probably going to do more like 1 or 2% in reality, but I like round numbers. So, but just doing, so Apple, you could see over 2 years, 30 days, 20 wins, 6 losses. I mean, and look at your returns here. I literally just picked random stocks and put them in, and the first 3 I put in were all immediately winners. So I picked a bank, I picked Apple, and then I picked SPY. I picked the most popular ETF, and you can see this huge win-loss ratio: 22 to 4, to 19 to 7, 48%, 39%. I mean, it's very hard to lose money trading covered calls. So that's my main point, and this is every 30 days for 2 years. Oh, the last 2 years. Sorry. Yes. All right. Obviously, what we're talking about here is a situation in a bull market, but in 2008, 2009, yeah, you would have made that much. You just wouldn't have sold the calls, right? So, but that's what I'm saying. In a major 30% up market, you're not going to sell calls against it. Maybe you're going to sell calls way out of the money or something like that. You still could find a way to make it work. But generally speaking, our years are like, the last couple, not like 2008, 2009. All right, so let's get on to my personal favorite way to trade, particularly directionally, are vertical spreads. So vertical spreads are just when you buy a call and you sell a call above it, or you buy a put and you sell a put below it. All right, so basically anytime you're doing a short or medium term trade and it's a directional trade, in other words, you're expecting something to go up or down, you should use a vertical spread. Right? That's my policy. If your option costs more than, let's say, 50 cents, then you need to cut down that premium cost with another option. There's almost no reason to do naked calls and puts, right? The only time is if you're doing a very long-term option, a leap, right, which is maybe 2 years out or 18 months out. And that's because at that point, it's almost like you're buying the stock, right? You're just buying the stock for leverage, and you're basically trading leverage for the chance to get a dividend on that stock by using leaps. That's a little bit different because, again, like it's so far out, it's almost like you're buying the stock itself. If you're doing a short or medium-term trade, you want to reduce your costs because well, I'll show you next. It's just such a easy way to reduce your risk and increase your return. All right. So picked Apple again because, again, there was a stock right on the wire. Actual trade here. Stock was at 85.50. This was the next day after that covered call trade on May 8th. Someone bought 1,000 of September 195s, and they sold 1,000 of the 200. So this is September, so they're thinking that Apple's going to go up about $10 to $15. Perfectly reasonable trade, right? The total cost of that is $1.59 because you're buying the 195s, you're selling the 200s. So that is a total cost of $1.59, which means your break-even point is just that long strike plus the cost, so $196.59. The max profit on something like that is your gap, right? So 200 is as high as you can make money in the stock, right? So if your max profit is $5 and your total cost is $1.59, you can make $3.41. So on this particular trade, that's $341,000 or 214%. If it goes up to 200, your max loss is $159,000. So you know exactly what your loss is. You know exactly what your upside is. If you were to buy the calls outright, okay, we don't have, your max gain is undefined because you don't know how high the stock could go, right? But the break even is significantly higher and your max loss is significantly higher, all right? Now, the chances are that a stock like Apple is not going to go to 250, right, in September. So, so we're not talking about a biotech. We're talking about the biggest company in the world. It pays a dividend. They do share buy. I mean, it's going to be more measured. So, to me, this is an obvious decision. Right? If you're holding something like a Leap for years and years, it's a different story. But if you're holding a 3-month or whatever spread, there's going to be a limit on how high it's going to go. And so why would you not want to reduce, you're basically you're paying a third of what you pay to buy to buy this option, and you're lowering your break-even point. Whenever I do a directional trade, I do a vertical spread. Like I said, it's got to be a super cheap option that for some, maybe it's a $10 stock and the options are cheap or something like that, where I don't use a vertical spread. I always recommend vertical spreads. And the vast majority of the time, it never blows past that strike. Most of the time when you get it right, you're somewhere in the middle. Sometimes, and you can use chart. If you're a chartist, you can use 200-day moving average or 52-week highs, so whatever it is that you like to use. I'm not a chart person. I will put my short strike at some of the more obvious trend lines, like maybe a 200-day, just because there's enough people who follow that you might see some resistance there, people selling out at 200 or something like that. Generally, I will try to use strikes that make some kind of technical sense. But again, that's not my forte. It's helpful also for when you're telling people what to do. It makes a lot more sense to say, okay, we're going to put this at the 200-day moving average. It's a good point to get out. Yeah. Yes. Yes. Yeah. So there are, my personal core strategy is selling options. I do, however, buy options when volatility is low, and this is how I do it. And as I said at the beginning, some people don't like selling options. So if you're going to buy options, this is how I want you to do it, basically. I do maybe a quarter of my trades might be long, and if they are, they're either vertical or the next strategies I'm going to show you, which are straddle and strangle. So that if I'm long, that's how I do it. So the pros, as I've said, it reduces your risk. You have much higher returns, all right? The cons, as I've said also, is that you can cap your gains. But here's what it looks like, that Apple trade. You can see, you've capped your gains. You've also capped your losses. You know exactly where your payout is. So it's just it's not a huge deal, but it'll save you a ton of money over the long term. but it's not a huge deal to do. It's very easy to put in a vertical spread, right? It doesn't require 4 legs. It doesn't require a bunch of extra commissions. In some cases, yes. Some cases, no. I mean, I will, if you want to get the full amount of your spread, generally you have to hold to expiration unless it blows through. I tried not to hold stuff to expiration as a rule of thumb, but sometimes I will. It's very situational. I usually have a profit target, so I might say, yes, you can make 200%, but if we make 75%, we're going to close out. So, I mean, again, it depends on the situation and my personal belief at the time. The thing about options is they're very fluid. What's that? Well, it's not, on something like that, it's not, on the vertical spreads, you don't really have to worry about assignment. But unless you're in the exact middle, and again, like I would close it at that point. If you've already blown through it, then you can't get assigned. If you're below it, you can't get assigned. So in that case, it's not an issue. That's another good question. So the thing about options is that everything is so relative. It's relative to how things are. Like what I considered low vol a year ago would not have been low, would have been ridiculous. Like when, the VIX is trading at 9, that's obviously low vol, but to me that's insane low vol, right? So normally, it's like if we're talking about the market, it may be something like 12 or under in the VIX, but it's always, every stock is a little bit different, right? So Microsoft normally trades at a 13% vol, right? So if I see it at 9%, it's low, but maybe a year from now, I think it's at about 15% right now. It might be 15% for the next 3 years, and then I'm going to consider anything under 15 low. So again, it's a very relative question. Just check my time here. All right, we're about halfway through, so we got plenty of time. Examples here using that CML Viz, Facebook, just a comparison of naked versus call vertical spreads. You could just see because you're capping your premiums, your percentage is it's going to be so much higher. So the key here, I mean, this is a little bit of a theoretical exercise because you're probably not going to hold, as the questions have been coming about expiration, you're probably not going to hold your naked calls to expiration. You're not necessarily going to hold your vertical spreads to expiration. So this is theoretical. This is holding everything to expiration, which, again, is probably not going to happen. But it's a very good illustrative point. If you were to hold everything to expiration, you would make so much more money because you've lowered your premium so much. That's really the point of this. So, I mean, you can obviously see the 3-figure percentages versus non. And again, the less you pay when you're long options, the better. Is really the point I'm trying to make. All right. Conversely, and this is probably even more illustrative, with Tesla, you would have lost money either way. But if you had used put vertical spreads, taking the short side on Tesla, right? A somewhat popular trade. People don't believe in it. They want to take the short side. You would have lost a ton of money over the last couple of years just buying puts. Again, this is on average over the last couple of years. Put vertical spreads. Look at the difference in terms of, buying the at the money and selling 110 delta, selling the 40, buying the 45, selling the 35. Just a couple different examples. So much you're spending less money, so your losses are considerably lower. I don't want to belabor the point, but the less you spend buying options, the better. Yeah. Yeah, if I don't, at least when it comes to my trading service, I don't leg into stuff because I find it confuses people. But if you're an advanced trader, you can leg into stuff, and that way you can turn it into a credit spread. You could turn it into a debit spread later on. I mean, yes, there's various ways of doing that. But again, it's your comfort level with options. But what you said is absolutely if you're comfortable doing that. All right, so number 4, again, I'm sticking on the long side here. This is the other strategy for, when you want to buy options when you're, low volatility, absolutely low volatility situation. And the reason I'm sticking with this low volatility stuff is because we had several years of low volatility. We've had a few months of high volatility. We're on our way back down. Very likely we're going to have a summer of low volatility again. So I think this stuff is very relevant to where we are now. So the difference is that with a vertical spread, you're picking a direction. With a straddle or a strangle, this is a situation where you don't necessarily have an opinion on whether a stock is going up or down. So this happens, my first point is this happens a lot more than you realize. So not just earnings. Obviously on earnings, it's generally a binary event, right? You have earnings come out, people are either impressed or they're not impressed, it goes up or down, right? But this happens a lot more. I mean, it could be based on, a Fed meeting. It could be based on a Supreme Court case. Today we had the gambling, right? We had the Supreme Court saying that you can sports bet, do sports betting in any state, which I highly recommend doing options rather than sports betting for a living. But if you were following this case, you might have taken Caesar's stock and you're like, all right, well, the stock is either gonna, if the case gets decided favorably, which it did, the stock's going to go up, and I think it was up like 7% walking into this session, right? It probably would have been down 7% or more had they not, right? Theoretically, right? So that's a perfect situation where you don't know what direction it's going to go. Caesar's, not necessarily a high volatility stock. That might have been a good situation to buy a straddle or a strangle. The difference between a straddle and a strangle is that's the V. You're buying the call and put at the same strike. The strangle is, and I'll show you a graph on the next page. The strangle is when if it's too expensive to buy that straddle, you just go a little bit further out. So it works again for ETF and index trading. So if you're trying to do this, let's say based on a Fed meeting, and maybe it's something like TLT, right? Maybe it's your long-term bonds, and you don't know what the Fed is going to decide with interest rates. You think TLT is going to move one way or another based on what they say. TLT is generally a very low volatility stock, so that's a good one to buy a straddle in. I've done that quite a bit, and it's worked. So here's 2 examples. Again, I pulled these directly from the TradeWire. Groupon, which is a cheap stock, right, under $5. So the straddle only costs 64 cents because it's such a cheap stock, right? And this one was based on earnings were May 9th or something. So this one was based on earnings, and Visa, conversely, this one's a long-term one, so this is a leap. But so that's why when you're buying so far out, it's going to be really expensive. It still costs $10.20 for one strangle. So, but this is an obvious difference. A long-term option on a high-priced stock is going to cost a lot. If that was a straddle, it would have cost $20. Literally, it was a $20 straddle versus a $10. So your break-even points are going to be a little bit further out than you have, as you can see with a straddle, where they're generally closer together. But that's really the only difference is just how much you want to spend. But this stuff can be really good for binary situations, and they happen quite a bit more than, I mean, there's usually like at least one time a week, right, where there's some kind of announcement. Earnings, obviously during earnings season, you have multiple times per week. The only problem with earnings is that everyone knows earnings are coming, and it's a lot of times the straddle and strangle are already expensive. You have to get in several weeks before earnings in order to get in before that stuff is priced in. And that's hard because a couple weeks before, the stock might already move a whole lot. So it's better on more economic events. People don't necessarily look at court cases or there's always economic news coming out, so people don't always necessarily, I'm going to look at the payroll numbers for April in February. Like that's something that's probably not on people's radar. So you get in a little ahead of time and you can do this stuff. And surprisingly, what we're talking about is generally a lower probability trade, but when you hit it, it's going to make a lot of money. Yeah. Sure. Let me see. Yeah, we have time. Let's. Visa was, Groupon wasn't just because the earnings were coming up, but it's so cheap that it doesn't matter, right? So how much volatility are you going to add to the price of a $5 stock? So in that case, it was so cheap that it really didn't matter. So this chart here, where the V comes to a point, that is where the straddle was put on. So in this case, it was 4.5. So you're long the call at 4.5, you're long the put at 4.5. That is your at the money. The red part is if the stock moves. So the stock was at 486 at the time. If the stock moves in that red zone, you would not make money. Anything that moves to the green is where you make money. So to get that price, you just add the long call and long put at 64 cents. So 450 is your mid strike, plus 64 cents means you have about 515 on one side, and then whatever a little high fours on the other, right? Or I'm sorry, high threes on the other side. So I didn't follow up on this one. I think it had moved at least 50 cents after earnings, but it might have moved more or less. So this one was pretty close to break even when I checked on it, but I haven't looked at it recently, so I'm not sure where it is. It would have expired May 11th, so they only would have had about 2 days after earnings for it to move. So conversely with Visa, right, the stock was at 129.43. You have this huge wide range, right? Because you're already, your strikes are at 150 and 115. So they're way far away. Now, this is 18 months, whatever, not 18 months. It's about 13 months. So you have a long time. Obviously, the stock could easily move in over a year. But this is these are your strikes where they come to a point. But you still have to go that much further before you start making money. And that's because it costs $10.20. Now, obviously, someone has a long-term theory on Visa, either that, maybe it's going to get killed because cryptocurrencies are going to take over the credit space or something, or it's going to take over the world, and and it's going to be the #1 credit card. So, I mean, they have some kind of theory, but they're not exactly sure, right? Oh, I'm sorry, yeah. Another fantastic site, Market Chameleon, best option site out there that's not, you don't have to pay for. I mean, they have premium features. This part stuff is not premium. You can get any of this stuff for free. Absolutely wonderful, pretty new. A couple guys that were former floor traders or they're former market makers that decided they wanted to offer options information. It's absolutely wonderful, wealth of knowledge. Highly, highly recommend. I use it every day. That's also where I get the block trades and everything. It's a wonderful site. Thank you. All right, so pros and cons of straddles. You don't have to pick a direction. You can get big returns. The cons are, of course, they can be expensive. And because they're more expensive, there's generally a lower probability trade. Yes? Mm-hmm. Yeah, but you want to obviously know what event you have in mind, right? I mean, I don't just buy straddles and strangles willy-nilly. I do, like I said, about 25 to 30% of my trades in the option profit engine are long, and I'll either use a vertical spread or a straddle or strangle. But I always have a thesis, right? So I think I did one on, I mentioned like TLT based on which is a bond ETF based on the FOMC meeting. I think I did one on gold. I like to do them with index ETFs or just ETFs in general. I think I did one on GLD. It was also based on some kind of economic event which I thought might move gold and something like that. Here, all right. So I did a 5% out of the money strangle. I did the same test with CML Viz, and this one I capped gains just because more realistically, you're definitely not going to hold straddles and strangles to expiration. You're going to probably take your gains or losses. So this one I actually added in 100% cap gains, 35% cap losses. And I just, kind of threw in some different names and tested. This also was I kept earnings. So you have the choice to keep earnings in or out. I believe I kept earnings in. So this does include possible earnings events, which is a lot of times when you use these on stocks. So Apple, SPY. The reason I put Overstock in there is because it was one of those crazy stocks on cryptocurrency, just to show you, for example. And then Tesla. So to give you an example of, Tesla is always a high volatility stock. It's very hard to do this sort of trade because it's high volatility. It's so expensive, right? Here's a situation where you have a stock that moves all the time, moves in big chunks. Not a good stock for straddles or strangles because it is just too expensive. No matter, even though it moves a ton, it's so expensive that you almost never make it back. So you don't win. You can see 9 versus 9, 6 versus 11. So most of the time, you're probably going to lose more than you win because it's a lower probability strategy. But when you win, it's a really big return. That's why this was done every 45 days. Obviously, you're not going to do it every 45 days. You're going to try to be, one of these where you have a theory, and again, your theory is not always going to work. But if you have a thesis behind it, your win-loss ratio should hopefully be a lot, a lot better than that. All right. So this is more of tips. This number 5. I want to go to this one because we've been talking a lot about selling options. And the reason selling options is it's generally, again, what I do. It is a very involved thing. I couldn't really talk about it in this session. However, tomorrow at 1:15, I talk all about it. So if you guys are around, my session tomorrow is all about is trading volatility, mostly on the sell side. It was way too much to try to fit in to this session, so I have 45 minutes tomorrow, and I'm going to talk all about it. So if you're interested in that, and that's, again, a little bit more what I do in the option profit engine. The stuff today is it's a little bit more if you don't want to have to risk, if you don't want to trade on margin and things like that, the stuff I'm talking about today is a lot more relevant. If you don't mind having margin and taking on a little more risk, although have higher probability, then selling options is for you, and we'll talk more about that tomorrow. So besides that, trade liquid options. This seems obvious, but I've made this mistake where I've done a trade in maybe an S&P 500 company, but it just doesn't trade a lot. And let's say I buy a vertical spread or something, and then it moves against me. And then I wait, and then I wait. Oh, it finally comes up towards expiration, and I close it out, and I realize I've made nothing because the bid-ask spread is so wide that by the time I got in and out of it, I've given up all my gains. Like, generally, it doesn't happen to that extent, but if you ever trade, so a secret as a former market makers make money on volume. So these stocks that don't trade, they don't want to be trading there. They're only there because they have to be. They have to be 10 up on the bid ask, but that's their job as a market. In order to be market makers in stocks like Apple and Tesla and SPY, they also have to take on some of these other stocks that never trade, and that's part of they would prefer not to make markets in those at all, but they have to. So their spreads are going to be really wide because that's the only way they're going to make any money on them. So there are times, obviously, if you have a very strong feeling about, whatever, Sherwin-Williams, and you think paint is going to be the next cryptocurrency, and you want to take a long position in that, all right, and I'm going to hold it for a year, fine. But if you're trying to get in and out of a stock like that, which I did, Sherwin-Williams, with an iron condor, and we got, by the time my people exited, we had given up almost all of our gains on the spread. So just something to look for. All right. So Genies, yeah, I'll get to that in a second. So the second one, look at the tape. So I've been talking about I've been using examples of different block trades and things that I've taken out from the TradeWire. You can get that stuff from that Market Chameleon site. Big trades come from savvy sources. There are very few people that trade 10,000 lot or 5,000 lot options that are idiots, right? I mean, these people have That's a ton of resources. They have generally these funds, and I've seen that side of it. You have some of the smartest people in the world doing this. So when you see big trades, they can be very good guidelines as to either directional or volatility or whatever it is that you're looking for. Big trades can be very useful. There are people that I know that only copy big trades. They look at these huge trades and then they do a smaller version in their account, and they generally make money. So just something to think about. All right, don't trade teenies. So teenies that's what we called them on the floor for now there wasn't even, it used to be a 16th. When I traded, we still did fractions. I think I was there when we went to decimals. So a 16th used to be the smallest, which is 0.0625. So right now that would probably be the equivalent of like a 5-cent option, right? For the most part, you never want to trade those. You don't want to buy them. You don't want to sell them. There are obviously extenuating circumstances where you might just have some ridiculously convicted belief in something and you just want to take a lottery ticket. For the most part, though, you're throwing away money. Definitely never sell them. Right? There are people who sell thousands of those things and then it only takes one move and they're bankrupt. But even buying them, I mean, spend a little extra money and buy something closer to the money. It's always worth it. But yeah, I mean, obviously the cover, right? I'm sorry, not closing, opening. Closing, obviously, you can close them, close teenies or sell them for. I mean, I just meant as an opening trade. So I talked about selling options. I'm not going to get into this too much. Binary options are, let's just say you can replicate anything you can do in a binary option in the real option market, and you can do it for a lot cheaper. Binary option is. You'll hear them called digital options. It's basically if you get past this, so let's say something is 50, like you buy a 50 binary option and you buy a call. Anything above that you make money. Anything below, it's 100% or zero. So it's just a binary situation. There's no delta where you it goes up, you make some money. It's either yes or no. So and a lot of the spreads are big. There's built-in basically vig for the house. A lot of times they push the short-term stuff, which is like, my option trades are generally a month long, sometimes a couple weeks, because you can't come up with a thesis in an hour, right? And if you can, and it's based on like a Fed meeting, then you would have been much better off planning ahead of time using real options, and you can easily replicate a binary option using real options. So they've gotten popular, but it's just use real options, and then. This goes back all the way to the beginning, February 5th. I don't think, and myself included, I didn't really realize to what extent a fund like XIV would have to buy futures after close in order to make their note good, right? They had to buy some ridiculous 100,000 future amount, and it blew up the fund, right? It's in the fine print, and most people, I mean, even experts didn't really understand what was going on. Yeah. Yeah. The question is that how could so many people be short volatility when it was already so low? And it's an excellent question. I actually do cover that tomorrow, but I'll answer it. So, buying VIX it's the most popular way to hedge. Institutions, because it was so cheap, they were buying futures hand over fist, buying long options. They were buying volatility because it was so cheap to hedge their portfolios. There is always demand because things like pension funds and certain ETFs and certain things, they have to hedge by rule, right? And particularly with VIX so cheap, people were buying. There were most of the big trades. If you looked in the VIX pit, most of the big trades were buying futures, right, or buying options. So the people selling. They were buying VXX or whatever method of getting long vol they were doing it a ton. So it was the retail trader on the other side of that mostly. There were some funds that were selling volatility, but for the most part, that's not how institutions were doing short volatility trades. So, thank you. Yeah. Yeah, well, it's like you get articles in the Wall Street Journal about a target manager, retiring to open up $100 million fund because he made, however X amount on XIV. I mean, it's kind of like, any other sort of bubble or whatever you want to call it, and in 2008, 2009, my wife is a elementary school teacher, and she had like her kindergarten teacher friends that were whatever, and first grade teachers, and they had all these rental properties. And I'm like, what are your, what do they know about owning rental properties? Like, they're making $40,000 a year as a teacher. What happens if the market blows up? And of course, every single one of them had to deal with foreclosures. It was a really bad situation. But I'm like, it was extremely popular. I'm in Arizona, right? It was extremely popular in Arizona for everyone to buy rental properties, no matter, and without really thinking about the consequences. And that's what was going on with short volatility. And again, I talk a lot about this tomorrow, that short volatility is extremely high probability trade because it mostly goes down. You have futures contango where it's pretty much always going down. But when it goes up 100%, right? And so that's what happened. Nobody was really that sure of what would happen with these funds because technically XIV, VXX, they don't have to liquidate. It's their choice. And one of them Credit Suisse chose to liquidate XIV, but they left SVXY to that one, they just reduced its exposure. So the important thing is that know what you're trading. This is probably very relevant with like cryptocurrencies and things like that. A lot of people are interested in cryptocurrencies. A lot of people don't really understand cryptocurrencies. So know what you're trading, particularly when it relates to volatility. Oh, I forgot to mention, if you guys want this presentation, I think there should be a clipboard going around, and just write your email down and I'll send you this presentation. And same thing with the one tomorrow, which is more about the stuff I'm talking about now. I think, yeah. It's a session, 1:15, I have a 45-minute session on trading volatility. 12:30? All right, it's at 12:30. Thank you. Everyone, it's at 12:30. All right, so summary, this is just what I talked about. Trade your edge. I can't really stress this enough. Do what you're comfortable doing. I like shorting volatility. Doesn't mean that shorting volatility is the only way to make money. And even there are plenty of times, like last November, December, even into January, where I did not short one bit of volatility because it just didn't make sense. But generally speaking, I'm more comfortable doing it, and I'm going to do that almost all the time if it makes sense, because that is what I feel comfortable doing. Yeah. Credit spreads I will talk about tomorrow. Again, I didn't have time to cover everything. Yep. Mm. Yeah. Absolutely the first one. Trade your edge, because it's the only time anymore that I generally lose money is when I move away from my comfort zone. I do have short volatility trades that don't work because, that's life, right? But last year I hit 44 out of 56 of my trades, so almost 80%, right? So that includes some long trades, but I'm very happy with that. But the times that I didn't hit a trade, generally I went away from my comfort zone. Back in the back of the room. I couldn't hear the. Can you guys hear me? Oh, VIX trade. Oh, sorry. I think probably I talk a ton about the VIX tomorrow. Oh, big trade. Oh, I'm sorry. Okay, I got you. Yeah, if you look at trading, like there are a lot of sites that will show you options activity, unusual options activity. Market Chameleon has a screener for block trades, so really anything over 200. And what I do every day is I sort that thing by quantity, and I look at all the big trades, and a lot of them are covered call trades. But a lot of them are vertical spreads, actually long vertical spreads are extremely popular. Some of them are straddles and strangles, not as much, but you have huge trades, and they're done by that kind of money is only done basically by funds, pension funds, ETFs, trading desks. Those people, and I know this from I've met these people. They're the smartest people in the world, right? They do this because they can make a ton of money, right? So they're really smart. Big trades. You have to kind of look at them and say, all right, is this a hedge? Sometimes it's a hedge, right? And obviously, that's if you're trying to speculate, then you don't want to copy a hedge. But if you can look at something and discern that this is a speculation on something, it's usually going to work out. More often than not, these trades that are big block trades, particularly in stocks that don't trade as much, that is generally they know something that we don't, or they've come up with an idea that we don't have. It's not necessarily insider knowledge or something like that. I already talked. Yeah. So the other tips again, just watch out for liquid options are best, and I mean, it's mostly trade what I think. If I can convey any point, is that trade with what you're comfortable trading, even if it's not necessarily the highest probability strategy. Just because, like, ultimately, if you're not comfortable, if you can't sleep at night because you don't like being short options or whatever, then you're not gonna make money. So, go ahead. Yes. All right. Gotcha. Yeah. So you asked about what exactly happened on February 5th. So we had a couple days where the market had been going down and volatility was going up, and then on February 5th was the day the Dow dropped over 1,000 points. It was, I think was it the tariff? I think it was the announcement of tariffs. Yeah, China tariffs that really pushed it over the edge. But what happened, the reason that it was so meaningful for option traders is because we had the blow up of XIV, which was a big short volatility fund. We had SVXY, which is another very popular short volatility fund that went from like 100 to 10 or something crazy. And you had, you had this huge outsized movement in volatility that shouldn't have happened based on how far the stocks went down. So stocks went down a lot for sure, but volatility went up like 3 times as much as it should have. And that's had to do a lot with, it was mechanical. It was like all this extra buying of volatility futures and stuff because of these funds having to fulfill their contracts. So if you were a short volatility trader, you got annihilated. Now, fortunately, I was using, vertical spreads, so I knew what my risk was, and it was, you could do vertical spreads on the credit side, which I'll talk about tomorrow. That I was completely protected. I knew what my loss would be. And then again, that's really what I wanted to talk about, is just always give yourself an out, right? Options are so easy to protect yourself and still make a lot of money. There's no reason to ever have XIV at 100 and have it go to 0 and not have a retirement. Like, that should never happen. So, yeah. Oh, then you would have made, it would have gone to 0. So if you bought the 80 put and it went to 0, you would have made $80, right? So XIV did not have options on it. SVXY did. So you could have done that with SVXY. XIV actually was not one with options, but yeah, theoretically, if you bought a put on XIV, you would have been really happy. Any other questions?